Street Secret. Unpacking the power and pitfalls of the SPLG ETF. Hey ETF enthusiasts, welcome back to Chat ETF. Today, we're diving deep into the SPLG ETF, the behemoth tracking the mighty SP 500. Passive investing darling or overrated giant. We're cracking open the hood to reveal the truth behind its popularity, potential pitfalls, and whether it fits your investment goals. Are you curious about passive investing made simple? Wondering if the SPLG ETF can be your ticket to market gains? Or maybe you're hearing whispers about hidden risks and limitations? Don't worry, we've got you covered. In this video, we'll demystify the SPLG ETF's investment strategy, fees, liquidity, and even its quarterly reconstitution process. We'll compare it to actively managed funds, expose potential drawbacks, and help you decide if it's the right fit for your portfolio. So, buckle up, grab your favorite financial beverage, and join the conversation. Because on Chat ETF, we don't just talk about ETFs, we make them relatable, fun, and insightful. Hit that subscribe button and let's get chatting. Question 1. What is the exact investment objective of the SPLG ETF? The exact investment objective of the SPLG ETF is to track the total return performance of the SP 500 index, before fees and expenses. This means that the ETF aims to deliver returns that closely mirror the performance of the index, which consists of 500 of the largest publicly traded companies in the United States. Here are some key points to remember about the SPLG's investment objective. 1. Passive management. SPLG is a passively managed ETF, meaning it doesn't try to outperform the market through active stock selection. Instead, it simply holds a basket of stocks that mimic the SP 500. 2. Market performance. Therefore, the performance of SPLG will closely resemble the performance of the SP 500. When the index goes up, so will the ETF, and vice versa. 3. No guarantees. While SPLG aims to track the SP 500, it is important to remember that it is not guaranteed to do so perfectly. There will always be slight tracking errors due to various factors. 4. Long-term investment. SPLG is typically considered a long-term investment strategy, as the stock market can be volatile in the short term. Question 2. What is the specific methodology employed by the SPLG ETF to replicate the performance of the SP 500 index? The SPLG ETF, also known as the SPDR Portfolio SP 500 ETF, employs a specific methodology to track the performance of the SP 500 index. Here's a breakdown. Portfolio construction. 1. Full replication. SPLG aims for full replication, meaning it holds all 500 stocks in the SP 500 in proportions that mirror their individual weightings within the index. This ensures close alignment with the index's performance. 2. Physical replication. The ETF physically holds the underlying stocks, rather than using derivatives or swaps. This approach simplifies the tracking process and reduces potential tracking errors associated with derivative-based replication. Portfolio rebalancing. 1. Regular adjustments. The portfolio weights are periodically rebalanced to reflect changes in the SP 500 index. This typically occurs when a company enters or exits the index, or when its relative weight within the index changes significantly. 2. Passive management. Rebalancing is done passively, following the index methodology, and doesn't involve active selection or market timing decisions. Additional key points. 1. Sampling. In rare cases, when holding all 500 stocks isn't practicable, SPLG might use statistical sampling techniques to achieve close tracking with the index. This is usually disclosed in the fund's prospectus. 2. Optimization. The fund manager might employ optimization techniques to minimize transaction costs associated with rebalancing. However, this shouldn't significantly impact the overall tracking objective. Question 3. What types of securities does the SPLG ETF primarily invest in to mirror the SP 500 index? Since the SPLG ETF aims to mirror the SP 500 index, the types of securities it invests in directly reflect the composition of that index. Here's the breakdown. Primary security types. 1. Large cap US equities. SPLG primarily invests in large cap stocks, meaning equities issued by the largest companies listed on major US stock exchanges like the NYSE and Nasdaq. These companies typically have market capitalizations exceeding $10 billion. 2. Diversified across sectors. The SP 500 covers a broad range of industries, and SPLG mirrors this by holding stocks from various sectors, including technology, healthcare, financials, consumer staples, industrials, and more. This diversification helps spread risk and capture potential growth across different segments of the U.S. economy. Specifics of the SP 500 composition. As of February 21, 2024, the SP 500 is comprised of approximately 55% information technology, 14% healthcare, 12% financials, 8% consumer staples, 7% industrials, the remaining 4% is spread across other sectors like consumer discretionary, materials, utilities, and real estate. No direct investment in other asset classes. It's important to note that SPLG does not directly invest in other asset classes like bonds, commodities, or real estate. Its focus remains solely on replicating the performance of the SP 500, which itself consists only of US large-cap stocks. Question 4. What are the primary risks associated with investing in the SPLG ETF? As with any investment, there are inherent risks associated with investing in the SPLG ETF. Here are some of the primary ones to consider. Market risk. 1. Equity market fluctuations. SPLG tracks the SP 500, which is an equity index. This means its value is directly tied to the performance of the stock market. As the market fluctuates, so will the value of the ETF, potentially leading to losses if the market experiences a downturn. 2. Volatility. The stock market can be inherently volatile, experiencing periods of significant swings in both directions. SPLG is not immune to this volatility, and investors should be prepared for potential ups and downs in the ETF's price. Tracking error. While SPLG strives to closely track the SP 500, there may be slight discrepancies in performance due to various factors like transaction costs, rebalancing practices, and potential sampling techniques. These tracking errors, although typically small, can contribute to a slight underperformance compared to the exact return of the index. Fund expenses. Like any ETF, SPLG charges annual management fees and other expenses that cover the costs of operating the fund. These expenses, while typically low compared to actively managed funds, can eat into your returns over time. Liquidity risk. While SPLG is generally a liquid ETF, there is a small chance that its price may deviate from its net asset value, NAV, during periods of high market volatility or low trading volume. This can make it slightly challenging to buy or sell shares at the desired price. Macroeconomic risks. The performance of the SP 500 and consequently SPLG can be impacted by various macroeconomic factors like interest rates, inflation, economic growth, and geopolitical events. Understanding and considering these broader economic trends is crucial for making informed investment decisions. Diversification. While SPLG offers diversification across different sectors of the U.S. stock market, it is still a single asset class investment. This means that your portfolio is exposed to the risks associated with the entire U.S. stock market, rather than being spread across different asset classes like bonds or commodities. Question 5. What are the specific criteria for inclusion or exclusion of securities in the SPLG ETF's portfolio? It's important to clarify that the SPLG ETF, or SPDR portfolio SP 500 ETF, doesn't actively choose or exclude securities from its portfolio. Instead, it passively tracks the SP 500 index, meaning its holdings directly reflect the composition of that index. Therefore, the criteria for inclusion or exclusion are determined by the SP Dow Jones Indices, SPDJI, the entity responsible for maintaining the SP 500. Here's a breakdown of the key criteria used by SPDJI for index membership. Eligibility criteria. 1. Market capitalization. Companies must have a minimum market capitalization of $8.2 billion as of September 30, 2023. 2. Liquidity. The stock must have a sufficient level of trading volume and float, readily available shares, to ensure adequate liquidity for index inclusion. 3. Financial viability. Companies must meet minimum profitability and financial viability requirements. 4. Headquarters listing. The company's headquarters must be located in the U.S., and its primary stock listing must be on a major U.S. exchange like the NYSE or NASDAQ. Addition removal process. 1. Quarterly review. SPDJI conducts a regular quarterly review to assess changes in the index composition based on the eligibility criteria. 2. Market capitalization float adjustments. Companies that no longer meet the minimum market cap or float requirements are removed from the index, while others that have grown sufficiently in size and liquidity may be added. 3. Industry classification representation. SPDJI also considers industry diversification and sector representation within the index when making addition or removal decisions. Question 6. What is the liquidity profile of the SPLG ETF, particularly during periods of market stress or volatility? The SPLG ETF, also known as the SPDR portfolio SP 500 ETF, generally boasts a high degree of liquidity, making it easier to buy and sell shares even under volatile market conditions. However, it's important to understand the nuances and potential risks involved. Advantages. 1. High trading volume. SPLG enjoys high daily trading volume, exceeding millions of shares. This ensures a readily available pool of buyers and sellers, facilitating smooth transactions even during periods of increased volatility. 2. Secondary market trading. Unlike traditional mutual funds, ETFs trade throughout the day on exchanges, offering more flexibility and intraday liquidity compared to waiting for the end-of-day NAV calculation. 3. Creation, a redemption mechanism. SPLG operates through an in-kind creation, a redemption mechanism, where authorized participants exchange large blocks of the underlying SP 500 stocks for creation units of SPLG shares. This mechanism helps maintain liquidity and track the index closely. Potential challenges during stress. 1. Widening bid-ask spreads. During periods of extreme market volatility, the bid-ask spread, representing the difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept, can widen. This means you may not be able to buy or sell shares at your exact desired price. 2. Tracking error amplification. In rare cases, if market conditions make it challenging for authorized participants to acquire the underlying stocks needed for creation units, the tracking error between SPLG and the SP 500 might temporarily increase. 3. Liquidity risk. While rare, there's a slight possibility that the ETF's price may deviate significantly from its NAV during periods of extreme market stress and low trading volume. Despite these potential challenges, SPLG's high trading volume, secondary market trading, and creation, a redemption mechanism generally ensure its liquidity even during market volatility. However, it's essential to be aware of the potential for wider spreads, tracking error fluctuations, and minimal liquidity risks during extreme market events. Question 7. What are the potential drawbacks or limitations of investing in the SPLG ETF compared to actively managed funds? While the SPLG ETF offers several advantages, such as low fees and broad market exposure, there are also drawbacks and limitations to consider compared to actively managed funds. Passive management. 1. No outperformance potential. SPLG passively tracks the SP 500, aiming to match its performance before fees. It doesn't attempt to outperform the market through active stock selection, which means it misses out on potential gains if the fund manager of an actively managed fund successfully picks winning stocks. 2. Limited flexibility. SPLG cannot deviate from the SP 500 composition, limiting its ability to adapt to changing market conditions, or invest in specific sectors or themes that the fund manager believes have high potential. Market performance. 1. Tracks the market downside. During market downturns, SPLG will decline in value along with the SP 500. Unlike actively managed funds, which may employ strategies to mitigate losses, SPLG offers no protection against market-wide corrections. 2. No sector rotation. As the SP 500 composition can change gradually, SPLG may miss out on short-term opportunities in emerging sectors or themes identified by active managers. Other considerations. 1. Higher initial investment. While SPLG's annual expense ratio is low, actively managed funds may offer lower minimum investment amounts, making them more accessible to investors with smaller initial capital. 2. Tax implications. Actively managed funds may distribute capital gains more frequently than SPLG, potentially leading to higher tax liabilities for investors in taxable accounts. Question 8. What is the process for reconstituting the SPLG ETF's portfolio to reflect changes in the SP 500 index? The SPLG ETF, also known as the SPDR Portfolio SP 500 ETF, doesn't actively manage its portfolio or make decisions about individual stock inclusion or exclusion. Instead, it passively tracks the SP 500 index, and any changes in the index composition automatically trigger adjustments to the SPLG ETF's holdings. Here's a breakdown of the process here. Quarterly review. The SP Dow Jones Indices, SPDJI, conducts a regular quarterly review of the SP 500 index composition. This review assesses whether companies meet the eligibility criteria and considers industry diversification within the index. Addition or removal decisions. Based on the review, SPDJI may 1. Add companies that have grown in size, liquidity, and meet the eligibility criteria. 2. Remove companies that no longer meet the criteria, or have been acquired by other companies. Index changes implementation. 1. The announced changes to the SP 500 index typically take effect on the third Friday of September. 2. On this date, authorized participants, large institutions that create and redeem ETF shares, engage in an in-kind creation or redemption process. 3. They exchange large blocks of the underlying stocks being added or removed from the index for creation or redemption units of SPLG shares. SPLG portfolio adjustment. 1. This in-kind exchange ensures that the SPLG ETF's portfolio automatically reflects the new composition of the SP 500 index. 2. No individual stock purchases or sales occur within the ETF itself. Alright, ETF friends, we've unpacked the SPLG ETF inside and out. Remember, there's no one-size-fits-all answer when it comes to investing. Whether the SPLG aligns with your goals depends on your risk tolerance, investment horizon, and overall portfolio strategy. If you're a passive investor seeking broad market exposure with low fees, the SPLG might be a solid choice. But be aware of its limitations, lack of alpha potential, and potential tracking errors. Actively managed funds could offer higher returns, but at a cost and with different risks. Host, we loved hearing your questions and comments throughout the video. Keep the conversation going. Drop your thoughts below, let us know what other ETFs you'd like us to crack open, and join the Chat ETF community. Remember, investing is a journey, not a sprint. Do your research, diversify your portfolio, and don't be afraid to ask questions. Until next time, happy investing.